Hey everyone, got an exciting show for you today. I got a returning guest, returning CPA, Evan Kirkpatrick. And last time when we talked a lot about buy and hold investing. We talked about depreciation, passive loss. We talked about being a real estate professional, and we just didn't have enough time to get into flipping. So we agreed to do our own show on that. So how you doing, Evan?
Good. How are you, man?
I'm doing great, man. Thank you for doing this. Taking 30, 45 minutes out of your busy week is greatly appreciated. Where do you want to start in this flipping thing? You want to kind of define it for folks because it's very different than buy and hold, right? It's more of it's more of a job, frankly. You want to kind of
Yeah, I
start
mean,
there?
and that's absolutely the dynamic that rules this. So flipping is we buy a house with the intention of reselling it. There's not going to be a period where we rent it out. We're buying a house with the intention of reselling it. Typically, this is done with some sort of rehab in the middle.
Mm-hmm.
Especially with real estate commissions, there's some items where you can buy low, sell high without doing anything.
True.
Stocks is obviously kind of what people talk about a lot of time with that,
Mm-hmm.
but any number of things. Houses aren't that because of the commissions and the closing costs. So there has to be some way where we buy a house, we buy a house for $100,000. We put $25,000 of work into it, and then we sell it for $175,000, something like that.
Mm-hmm.
And like Michael was saying, it's very much more like a business.
Mm-hmm.
It is not something that can be done passively.
Right.
In the sense of you can't just like buy it and say, hey, you go fix this house and you do your thing, because there's so many other elements that come into play versus like with some sort of turnkey rental. The point of a turnkey rental is you can just buy a house and, you can get a management company to put a tenant in, and like you really don't necessarily have to do that much.
Mm-hmm.
You might not necessarily make a lot of money doing that, especially in the short term, but you don't have to put a lot of work into it. Flipping is kind of the opposite end of residential real estate, where we're going to put in a lot of work for the expectation of being able to generate a lot of return in a short time period. Mm-hmm. This has a lot of implications. I see a number of people like the most likely number of flips a real estate investor has done is one, because they do it and they don't like it.
They do it once. I didn't like that. That was terrible. I'm out.
and there's nothing wrong with that.
No.
I tell people like, hey, like if you break even on the first flip, you're doing well. You're doing fine at a minimum, because there's a lot of learning that goes into it. Mm-hmm. You have to figure out how to buy ID properties that are good flip candidates. Well, first you have to figure out how to like get in the loop of even seeing properties that are good flip candidates, yeah. IDing them, accurately estimating how much it's going to take to fix them, mm-hmm. IDing what you want to fix them into so mm-hmm. you don't over repair them, which mm-hmm. happens a lot. Figuring out what it looks like in terms of hiring contractors. Up until recently, and probably in a lot of places still now, the biggest issue has been hiring good contractors.
Yeah.
And a lot of that's because the biggest issue for the contractors has been hiring good people to work for them. I work with a number of contractors as well, and employment struggles have been constant when you talk to them for years now. Mm-hmm. They can't hire good people to work for them, so they can't staff out their projects sufficiently. Right. So you have to get all that stuff. For most people, it's like figuring out how to be your own general contractor, or at least mm-hmm. figuring out how to ID a general contractor that's good. And then getting it listed and sold. And not to mention you have to finance all of this stuff. Yeah. Banks don't like doing financing on flipping properties most of the mm-hmm. time. Their model is based off of loans being outstanding for longer terms than that. Mm-hmm. This is where like hard money comes into play. Hard money being essentially borrowing money from an individual mm-hmm. to cover, the down payment because you're not living in it. You're gonna have to get to 20% up front, and then you're probably gonna have to finance your own repair costs and things like that. And a lot of flippers, they're using money from essentially private individuals mm-hmm. to do this. Mm-hmm. So you have to get that connected, and so there's a whole bunch of steps that come into it. But the reverse of it is that if you're good at flipping and you do it well, it's a sort of thing where you actually can like make a lot of money in a short time period. You can flip, the expert flippers, they can flip 20, 30, 40 houses in a year, and make, 20 or 30 or 40 or more on each of them. And obviously they're paying some people. They're not just managing all this themselves. They'll have like their own project manager and stuff like that. So they're having to split that up. But you can actually build a quote unquote scalable operation off of this stuff in a way that you can't necessarily do with residential real estate.
Yeah.
And there's, we could have a whole conversation on what scale means and what scale looks like in this sort of context.
Yeah.
And it really depends on your goals. But if you're trying to make money in real estate, it's not necessarily about like preserving your wealth plus getting some return, but like if you're really trying to change your financial fortune, well, okay, flipping might be a way to do it. Flipping is also a way to potentially lose a bunch of money in real estate
for sure.
more quickly.
Yeah.
If you over repair, if you just buy bad flips, if you have the market fall out from under you while you own, I've got 6, if you're someone's like, I got 6 flips right now, and then prices take a 20% haircut. Well, sorry, like you're toast. Maybe not toast, but like it's.
Oh, no, you're toast. I knew a guy that was worth $10 million legit and lost it all in 2008 because he got caught with $5 or $6 million flips in the Bay Area that all went under water at the same time, and he just couldn't get out of the way. It happens.
Yeah.
Yeah.
And you could do flipping with things, flipping concepts apply to things beyond just single family and duplexes. There's a lot of flipping, a lot of syndicated apartment complexes.
For sure.
A lot of the apartment complex deals, it's done with this forced appreciation concept in mind. Forced, in order to get the economics of the usual real estate deal work, but you could do a lot of the flipping concepts and turn them into single family or turn them into rentals.
Mm-hmm.
And there's enough people chasing deals right now that in order to get the economics on a deal work, generally, if you want something to cash flow right away, or you want something to make money right away, you have to do some sort of work on the inside.
For sure.
There's just, the margins are too thin to just buy properties that are essentially ready to roll. And, if you're just starting out, unless you have a real good deal conduit, you just have someone that just like gives you a gift.
Mm-hmm.
If there are deals that don't necessarily take that sort of work, they are probably not going to come to you, because the people that want to, hey, I've got this hot deal here, they're going to go first and foremost to someone that will close quickly.
Mm-hmm.
That's the number one thing that they know will close and will close quickly. That's where the good deals go to. And that, again, that goes into a whole conversation about scale in real estate and things like that, where the more deals you do, the better position you are to get more deals, because people know that you can execute. If you get a good tip from someone and you're struggling to finance it and like you can't close because you can't get your hard money in line and all that stuff, it makes it tougher for that person to come back to you. But if you can get all your ducks in a row, the more that you can prove to like people in your pipeline, hey, like I will be the one that will get this done for you. I will get this done quickly. You will get paid quickly.
Mm-hmm.
That makes them want to come to you.
Right.
With your contractors, it's like, hey, like we're going to have a reasonable rate, but like I have deals, like I'm going to make sure that if you do what you're supposed to do, I take care of you. Those are the sorts of people that will work with you. And that's where like flipping becomes a business.
Exactly.
Real estate becomes a business because it is about building relationships. It's about having some amount of volume in there. It's about, building systems where it's like the reason why the first flip doesn't make money. A lot of times it's not necessarily because like the deal was estimated badly or like the contractors are bad. A lot of it's that it takes too long.
Yeah. It's time.
And
yeah.
The holding costs, the interest, the prorated taxes and insurance.
For sure.
You get eaten up because what an experienced flipper could do in 3 months, it takes you 6 just to kind of go through all the steps. And that's not bad if it's a learning experience.
Yeah. And that's why from 2015 to 2019, flipping, frankly, was sexy because people were making mistakes, but time was bailing them out, right? You were actually having price inflation, right? A 3-month job took 6 months. Well, great. The market went up 2%. So my holding cost was covered. That doesn't happen.
Yeah, where it's just like, especially because, and just there's a simple math way to think about it. Like if I'm paying 10% a year on interest, well, I'm only borrowing, 80% LTV or something like that. If these prices are going up 2% a month or whatever, Like, okay,
You win.
like, yeah, but that's not normal.
No, true.
And right now we're also in like the lowest interest rate environment, hopefully what we're going to see. And with hard money too, your rates get better with experience, right?
Sure,
Like,
of
because
course.
hard money, it's a single individual. Like, I am trusting you with my money. Don't screw it up.
Mm-hmm.
And when you can come to them with a track record, it makes it a lot easier for them to say, here, just take this.
Yeah.
I
Question.
know that this is probably going to work.
Yeah. One question I had for you, and again, I want to piece some vocabulary or words you've used just to make sure everybody sees it. One of them you said was short term, right? Is there a length of time where the tax treatment is treated differently? Is it a year? Is it 2 years? Right?
So flipping in general is a business.
Mm-hmm.
It is treated as a business. Net flipping income and business income, it's all a net income concept. It's not about how much I sold something for. It's about how much I sold something for, less what I bought it for, less my operating expenses.
Mm-hmm.
Flipping is a business as far as tax is concerned.
Mm-hmm.
If you're only doing like one flip or something like that, there can be alternatives. But if you're doing flipping with any amount of regularity, it is a business. It creates earned income,
Okay.
Which is taxed at ordinary rates, which is subject to the self-employment tax.
Yep.
Assuming you don't do structuring things to avoid that. And this is something that trips a lot of people up because they're not adequately prepared for the tax consequences. But it is earned income. In that sense, the holding period doesn't matter. Now, if you're talking about doing, a rehab and then you're putting it in as a rental and then you hold the rental for a year, then, if you rent a property for a year, then it's not ordinary income anymore. That's long-term capital gain, and that's a whole different ball of wax. But for this conversation, let's just say I'm just flipping houses. I'm never renting them. That's a business.
Right. So even if you had a flip that for whatever reason took a year, if the intent was to be a flip and it wasn't, some kind of land, you buy and hold and then became a flip, even if it's 13 months, it's still active income.
Correct. It's not any different than like, hey, like I bought a basketball and it sat on the shelf in my store for 13 months and then I sold it.
Got it.
Well, that doesn't become an ordinary asset. It was bought for the purpose of resale.
Very cool.
So,
and I think this is still true. If if it's a primary residence, is there still that treatment for 2 years? If you
yes.
Okay.
For your primary residence, if you have lived in your primary residence when you sell it for 2 out of the last 5 years, then when you sell it, you can exclude for a single person up to $250,000 of gain, for a married couple up to $500,000.
Yeah.
And there's various technical provisions in there. If, for instance, if you own a rental and then you convert it, or excuse me, if you own your prime residence and then you convert it into a rental, which happens frequently, and then you sell the rental, there can be various limitations on the gain exclusion, although you still get the bulk of it. There's still a major incentive to sell within that 5-year period. If you can say, I have lived in it for 2 out of 5 years, right. I rented it for 2 years at the end, and then I sold it. Yeah. You still get a gain exclusion in there.
Yeah, the reason I brought that up is because I live in Silicon Valley, which is the land of average $1 million homes. I actually know several people that they do that. They basically move into an old 1950s 3-bedroom 1-bath ranch. They then remodel it. They live in it, so they legit live in it, and they just spend 2 years remodeling every square inch of it. And then 2 years or 2.5 years, they go on to the next one, and then they.
Yeah, it's kind of a different form of house hacking.
Exactly.
Which is a concept related to duplexes and rentals and kind of, I keep bringing up terms, but
that's okay. But that's legit, right? That is absolutely 100% a legit thing to do.
But in the Bay Area in particular, because this appreciation has been so predictable for the last few years, and it'll be interesting to see in the Bay Area in particular how that holds now. Now in the work from home era. Sure. But yeah, I mean, that's definitely something you can do. I've also seen people in the Bay Area where, it's the kind of the one place that for actually like relatively average upper middle class people, that a $500,000 gain exclusion hasn't necessarily been enough.
Yeah, it's true.
For people that like bought in the 90s and are selling now, it's like, I bought this house for $175,000. It's worth like 1.3 million.
Yeah.
And you can actually have income tax on the sale of your primary residence if you get past this gain exclusion.
No question.
Most people, like if your house is worth less than $500,000 and you lived in it 2 of the last 5 years and you're a couple, okay, you can't have any gain, right?
Yeah.
But That's kind of the one place where that gets tested.
Yeah, no, and again, a couple of people that I know do it. It's again, they've been able to do it. I think their net profit has been somewhere between $350,000 and $400,000 several times, and that's tax free, right? Assuming they've stayed in it, they lived in it, right? They follow all the rules. So
and it's kind of a special, it's been a special strategy they can employ in this one particular period.
Yeah, very unique.
If you're listening to this right now, that's probably not what you want to do.
Yeah, true. Yeah, very, very true. The other thing you talked about is intentions. Right at the beginning of your walkthrough is your intentions to flip. So I wanted to scratch that a little bit. Let's just say I buy a rental because I'm a buy and hold guy. And then my intention is to rent it. And then for whatever reason, somebody comes out of the blue and offers me more money and I sell it. So I just want to scratch that word intentions. What was when you
we're talking for tax purposes here?
Yeah.
I mean, ultimately your intent matters for some things, but for this purpose, ultimately it's going to be what actually happens that governs the tax treatment. So I was intending to put it in as a buy and hold rental, but I never actually did. I never had that rental period. It actually, if you didn't know my intent, it looks like a flip. For that purpose, it will be taxed like a flip. The reverse is actually true.
Okay. Yeah, I just wanted to make sure I scratched all the words that could be defined.
Yeah.
Okay. And then because it is a business, that allows you to take other good expenses, right?
Yeah. I mean, the big stuff that comes up a lot of times in flipping businesses is one, they spend a lot of money on advertising or forms of marketing.
Yep.
You don't have to do that to be a successful flipper, but most of the ones with some amount of volume, they're doing some sort of paid advertising. Obviously they can write that off. If you've got a VA or an assistant or something like that, VA is a virtual assistant. You got someone that's answering the phone. That's relatively normal for flipping too, because it's based off of, hey, this person's trying to unload their house in a hurry. And so I got to pay this person to deal with it. All that sort of admin stuff. If you maintain a physical office, if you're flipping 30 houses a year, you're gonna have a project manager, you're gonna have a physical office, and for all that, anything that a business could deduct, a flipping business can deduct. The IRS terminology and the code is ordinary necessary. If it's an ordinary necessary business expense, you can deduct it. That's really not that high of a bar ultimately. I mean, it's going to encompass a lot of things. Like if you're a flipper and you spend money to go to real estate conferences, you spend money to go get additional training, you spend money to travel to new areas or to existing areas and look at different stuff. All these different things. You pay referral fees. Those are usually actually could go into a particular project, but just because something's not chargeable to a specific deal doesn't mean you can't write it off for tax purposes. There's a lot of that's actually true for buy and hold also, which is something that's under-levered a lot of the time. But, it really comes down to, is this something that makes sense to spend money on to make more money? I'm spending this money on this thing because I have an expectation that it's going to help me make more money.
Right.
Then that's when you get deductions.
Yeah. So when you think about, I don't know if you want to call it mistakes or maybe it's opportunities missed is a kind way of saying it. When you think about the flippers that you've looked at, and again, you're looking at them from the income statement, right? Or cash flow statement as well. What are some things that are opportunities missed that you've seen and you've helped people tweak so they get more of a benefit? Is it the deductions that they're not taking, or what is it?
You can get some of that. A lot of it, the biggest thing I would tell someone that's starting out is keep incredibly good records. However good your records are, keep better records than what you are. Because the biggest issues we see are, hey, we just lose track of where everything is. We can't figure out what to do with this stuff. And, what you can't do to an accountant these days is you can't just go and be like, here's a stack of receipts or whatever, figure out how much money I made on this.
Yeah.
Well, one, the business just doesn't really work that way these days. And you're not going to get the quality of person working on your account that you want if you make them do all this stuff, or they're going to charge you a lot of money to do it.
Yeah. Ridiculous. Yeah.
We don't like doing that.
No, of course not. Yeah. Yeah.
We want to see things be categorized and organized, and essentially hey, for each flip, okay, this is how much it costs. This is what I spent. Yeah. And the truth of it is that you need to know those things. You can't sit around and wait for me on the tax side to tell you an answer. like in June,
Right.
when you close this flip 13 months ago, like how on earth are you supposed to make intelligent financial decisions at that point? You have to know your numbers.
Yeah.
That's why accounting exists. Accounting conceptually doesn't exist for the feds. A lot of people, I only do it because of income tax.
Right.
But you go. I have 2 degrees in accounting. You go sit in a graduate level, essentially like accounting theory class. Like, why does accounting exist? Is to so that people can make management decisions. So
Correct. Yeah.
that's why, and you have to do that. If you're flipping, you have to know your numbers. You are managing a business.
Mm-hmm.
And so in some form or fashion, at small scale, Excel's fine.
Yeah.
Is, buy and hold, flipping, like either way, like Excel's perfectly fine. But you need to know, this is what I bought. This is what I'm spending. Really, I would say if you're doing a flip, if you're doing a buy and hold and you don't have a pro forma, which a pro forma is essentially like an estimate of, this is what I expect for buy and hold. Like, this is what I expect, like my annual rent to be, my expenses, all this, and my net cash flow, my net income. Or for a flip, like, this is what I expect to buy it for. This is how much I'm going to pay in rehab. This is how much I'm going to pay in holding costs for interest and taxes and insurance and all that. And, this is how much I'm going to pay in closing commissions, how much I expect to sell it for. If you don't have an estimate, you don't have that pro forma for every deal, you're opening yourself up to just make a bunch of mistakes.
Yeah. The one thing that when I look at kind of I don't think the average person appreciates financial statements the way they should. Right. I think most buy and hold investors kind of focus on the balance sheet, maybe a little bit on the income statement, but the ones for flippers that I think we should talk about more, because it's the most underappreciated is the cash flow statement, right? That cash flow can kill you, even though you're, making money, if you will. But if your cash flow statement is not healthy, you could be in trouble. Would you agree with that, or am I just
crazy? What it comes down to for flippers in particular is that it's one thing if you are deeply capitalized. And what I mean by that is if you have a bunch of money, if you can bring a lot of money into your flipping business to start with so that you can finance your advertising and your operations. This doesn't mean that you have to like bring a bunch of money where you're not using hard money to like to do things.
Operating
that's
capital.
Different. But yeah, so that you can pay contractors and like have cash in the bank to pay for things. Then you having that cash just makes it way easier. But a lot of people that get into flipping, they don't necessarily have a lot of money to start.
Mm-hmm.
And that's where, that cash flow statement concept comes into play, because it can be like, hey, economically, I'm going to make a bunch of money off of these deals I haven't processed, but I'm in trouble right now because the bank account is empty because I have a bunch of money tied up in these deals at any point in time. If I'm doing 4 flips at once, well, how much money have I spent out of my pocket in down payments, in marketing for these things, for my operational costs? I was in this conversation with someone a couple of days ago where like, they've got a flipping business. They've got a really good, consistent source of leads. They're spending a decent amount of money on ads. They're spending $7,500 a month on ads.
Wow.
But they get 1 or 1.5 to 2 deals a month. It's consistent. Then the issue they're having is that they don't have enough money to increase their volume. And we had a long conversation about what to do with this. And that's just kind of like, hey, when you're talking about cash flow statements and things like that, it's like, what's the problem I'm trying to solve here? And usually it's, I can't increase my volume because I'm out of money to just seed these deals. And a lot of that, it comes down to just naked reality, and that like, okay, this is what we can do from a cash flow perspective. And I can either borrow more money in some form or fashion. I can get some sort of outside investor that I'm cutting in from like an equity perspective, a percentage of ownership, or I can suck it up, bootstrap the thing, live tight, make some money on these deals, save that money so I can do more deals at a time and scale that way.
Yeah.
And you really have to understand what you're trying to do.
I'm curious because I think cash flow statement is the most underappreciated statement. It's the least talked about. And again, you may not have an answer, but I'm going to ask it anyway. If you were to take some novice, a flipper, right? Somebody's excited. They know how to, I don't know, they're a contractor or whatever. Where would you send them to just get a cash flow 101 education? Is it YouTube University? Do you have a book you like? Any thoughts there?
it's kind of almost like telling the fish how to or asking the fish, how he learned to swim in some ways.
Okay.
A lot of it's truthfully, we have a lot of those conversations, and that's a lot of, where we're spending time talking to people. I would say read voraciously. I read, there's a whole, this is really just like a tithe of like the various business books I have, but like, I've got books over here on flipping. I've read all sorts of stuff, like I read, and I'm not a flipper. I read this stuff so I can talk to clients and so I can understand the businesses that are going on.
Oh, that's awesome.
Like that. We've got the famous Gary Keller book on how to be a real estate agent, all sorts of different stuff where it's just like,
I have that one too somewhere.
And like something like this, this isn't like rocket science. It's not in here. Like, I'm not sitting in here like, oh, this is all earth shattering or whatever. But like, for instance, if you're talking about like being a real estate agent, like you go find something like this, or there's the equivalent book on like how to be a real estate investor, which is probably 20 years old now.
That's my favorite book.
It's going to tell you a lot of nuts and bolts mechanical stuff on how to think through this stuff.
Yeah. Can you flash that blue book again? That is my number one favorite book. And it's really because of the stories that are in the back, the last 20 pages or whatever. I like reading about.
And so like, if like anything Gary Keller's written is just really good for like starting to think through stuff. Both these are kind of more mechanical nuts and bolts on different parts of the real estate industry. He's written some other stuff, kind of more strategic layer, which is also really good.
Shift.
And what this does, something like this does, is this gives you a starting point to figure out what more you need to learn. It's not like this is some end all be all. Like you can't like, I can't read this book on how to be a real estate agent and then like go out there and be like the world's best real estate agent.
No.
Because half of them have read this book too, but what it's going to do is it's going to stop me from making a bunch of like fundamental mistakes like right now.
Yeah. And I think that's awesome that I'm trying to think. I'm sure there are some accounts I know that do that, but not many don't, right? They kind of stay in their lane. They're not reading. They're not investing in themselves to have better conversations with their clients. So that's a very nice job, Evan.
Yeah. And we might, but like it's just what's necessary to understand the business in a lot of ways. And truthfully, it's like something like, this book on like how to be a real estate agent, you can take this and like most like, out of your house sort of like service type businesses. There's a lot of stuff in here that applies to all that. Yeah, I'm a big proponent of essentially like learning all you can about different, it's like intentional cross-pollination of concepts from different industries.
That's awesome.
Because like if I'm an accountant, if I'm a flipper, if I'm a real estate agent, if I'm whatever, well, the people in my industry are probably, especially like the top third, the top quarter are going to be really well learned about their industry. And how do you get an edge on these people? You have to bring in concepts from other areas.
Totally agree.
You have to kind of outpace their knowledge in some way, because these days, like the nuts and bolts stuff with the internet, you take one of these, you go to Bigger Pockets and you read a bunch of stuff. Like you can educate yourself real fast.
Yeah, you can get to first or even second.
That's for real estate.
Yeah, that's pretty cool.
But what makes the difference here, and this is a big thing in my industry too, by the way, like you don't actually have to have a license to prepare tax returns for money. You don't have to be a CPA. You don't have to be an IRS enrolled agent. You don't have to be squat.
Oh, wow.
And you see all the time, like, there's coaching programs and stuff like that, kind of just like with flipping, where it's like, here's how you can start your own tax practice now, and you can sell tax planning services and how like outsource CFO and all this stuff. And you get all these people that start doing it and they don't actually know anything because there's just this program or whatever. Less, warning to everyone out there, like make sure that whatever tax person you're working with actually like knows things and can have this sort of conversation with you. But, just because, anyone can go out there and do something like that. And if you want to get into flipping, you need to do that, but that's not the end point.
Yeah.
That's how you start.
Very cool. Well, Evan, I want to get you some more business given you're investing in yourself. And again, this channel is Flipping and Buy and Hold. How can people get a hold of you, reach out, see if they can become one of your clients?
So you can email me at ekirkpatrick, so EKIRKPATRICK at kirkpatrickpllc.com. You can always call our office at 512-246-9669, or you can reach out to me, Evan Kirkpatrick, on Facebook, LinkedIn, or Kirkpatrick CPA, PLLC on either of those. We've been doing videos throughout this whole process, especially for like our contractor clients, our small business clients, on the Paycheck Protection Program, SBA loans, all sorts of different stuff, all this CARES Act stuff. The one that came out, I believe, just this morning on the new PPP Flexibility Act in terms of, hey, if you've taken the stuff, you get more time to spend it and all that fun stuff. And so we're trying to keep everyone in the loop as we go on all the new stuff that's going on. Depending on how elections go in November, there could be another seismic tax change in the next 18 to 24 months. It seems pretty likely to me at this point. And so you really you need someone that's going to help you stay on top of these things.
Absolutely. So Evan, can you give the phone number one more time? Because I want to put that in the description.
512-246-9669.
Very cool. I will put your email and your office number in the first 2 lines of the description below. Evan, thank you very much for doing this. Give me another half hour of your time. It's very, very helpful, and look forward to getting your phone ringing.
All right. It's been fun, man.
Thanks.